One piece of data just dropped that could quietly add $1 trillion to the stock market. And almost nobody's talking about it the right way. If the bullish case plays out, this isn't maybe the S&P drifts up a few percent. This is the kind of setup that can supercharge stocks, crush the bears, and leave anyone sitting in cash wondering what just happened. You're watching the comment section with Thomas Paul. Let's talk about why this catalyst matters, what could go right, what could go very wrong, and what's actually worth watching instead of the usual hype. Quick disclaimer before we dive in, nothing in this video is financial advice. I'm not your advisor, I don't know your situation. This is information and opinion. You make your own decisions and live with the consequences, just like the rest of us. All right, the very bullish catalyst everyone's circling around right now comes down to one basic idea. The economy might be slowing just enough, at just the right time, to let central banks cut rates without breaking anything. That's the soft landing dream. Inflation is trending down from its peak, but growth is still positive. Unemployment is low, corporate earnings haven't fallen off a cliff, and wage growth is cooling but not collapsing. In other words, we might be walking the tightrope and somehow not dying. And here's where things get interesting. If that balance holds, you get a very specific chain reaction that is insanely bullish for stocks. Think about it this way. When interest rates fall, cash and bonds get less attractive. Yield on safe stuff drops. So big money starts hunting for returns in risk assets again, stocks, real estate, credit, even some of the weirder corners of the market. Lower rates also help companies. Borrowing costs go down. Refinancing debt gets easier. Growth projects suddenly start to make sense again on paper. That can boost earnings expectations and justify higher valuations. So you combine okay economy with cheaper money and no obvious crisis on fire. And that's how you suddenly wake up in a world where the S&P is at new highs and everyone pretends they saw it coming. But wait, it gets even wilder. It's not just the level of rates, it's the direction and the story. Markets trade on narratives, and the bullish narrative right now is this. We beat inflation without a recession. The worst is behind us. The next decade is AI, productivity, and growth, just like the 90s, but with better memes. Once that story sticks, people stop asking, is it safe to be in the market? And start asking, am I missing the upside? Behavior flips from fear of loss to fear of missing out. That shift alone can push stocks higher, completely independent of actual fundamentals. And if you think that sounds irrational, welcome to the stock market. It's been like this forever. Let's hit a few key takeaways from this very bullish setup, but calmly, without the confetti cannons. First, cooling inflation is the backbone of this whole thing. We've gone from runaway inflation to something closer to annoying but manageable. Not perfect, not fixed, but trending in the right direction. That gives central banks political and economic cover to start talking about cuts without looking reckless. Second, the labor market is bending, not breaking. Job openings are down from their peak, wage growth is moderating, and some sectors are clearly feeling pain. But we aren't seeing mass layoffs across the entire economy. Think of it like a hot job market slowly normalizing instead of crashing. This matters because if unemployment stays relatively low, consumers keep spending, and as long as people keep swiping their cards, corporate revenues hold up. That supports earnings, which support stock prices. Third, corporate earnings themselves have been stubbornly okay. Not amazing, not catastrophic, but good enough. Companies have been surprisingly good at protecting margins, raising prices, cutting costs, strategic realignments, which is corporate speak for, we laid off people but we phrased it nicely. I remember when I got laid off in one of those strategic realignments. The press release sounded like the company had just discovered the cure for cancer. Meanwhile, regular people were cleaning out their desks. That's when I stopped taking corporate language at face value. But from a stock market perspective, those decisions often boost earnings in the short term. Less payroll, more profit. Wall Street claps, human beings, not so much. Fourth, liquidity is still out there. There is a lot of money sitting in money market funds and short-term bonds, earning decent yield. If rates actually start dropping, some of that cash becomes restless. Suddenly, a 5% safe yield turns into 3%. And that starts to feel a lot less exciting compared to equities with potential upside. Put all that together, and you have the recipe for a very bullish path: moderating inflation, stabilizing labor, decent earnings, and a wall of cash that might rotate into stocks. Now, here's where you need to be careful. And this is where my childhood kicks in. When I was about 12, my parents trusted a very confident bank advisor and ended up losing most of their savings. No crash on TV, no dramatic movie scene, just a slow bleed. The dinner table got very quiet for a long time. That's when I learned experts can be wrong, and happy headlines don't protect your money. So let's talk about the cracks, the what-ifs, and what you should actually watch instead of just chanting bull market into the mirror. First big risk: inflation isn't fully dead. If inflation stalls on the way down, or worse, re-accelerates, the whole rate cut fantasy gets delayed or derailed. Suddenly, that very bullish catalyst turns into higher for longer, and high valuations start to look fragile. Second, earnings expectations might be too optimistic. Markets don't price what happened. They price what people think will happen. If the current expectations bake in a perfect soft landing and strong growth, there isn't much room for disappointment. One bad earnings season, one guidance cut from a major company, and suddenly the market has to reset its hopes. Third, financial conditions can tighten again very quickly. All it takes is one credit event, a big default, a blow-up in commercial real estate, a bank wobbling, and risk appetite can vanish. We've seen that movie before. It usually premieres on a random Thursday when you least expect it. So what should you actually watch next if you want to be data first instead of vibes first? Number 1, the trend in core inflation and services inflation. Goods inflation can fall pretty quickly. Services are stickier. If services inflation keeps grinding down, that's a green light for easier policy. If it gets stuck, that's a red flag. Number 2, the labor market turning points. Not just the unemployment rate, but job openings, quit rates, and hours worked. When companies start trimming hours before they trim headcount, that's usually the early warning signal. Number 3, credit spreads. If investors suddenly demand a lot more yield to lend to riskier companies, that's the market saying, we're worried. Tight spreads mean bullish, we're chill. Wide spreads mean things are breaking somewhere. And number 4, earnings revisions. Analyst estimates getting revised up. Bullish momentum has real fuel. Revisions turning negative across sectors. That's the market quietly pulling the rug. But wait, it gets even more fun. We're watching all this in an environment where AI and automation could push corporate profits higher for years, while also creating a lot of social and political tension over jobs and inequality. That's the part that never makes it into the bullish PowerPoint. The same tools that help revenues and margins look great can also make people very angry when they see efficiency upgrades replacing actual humans. So yes, you can have record stock prices and a very annoyed population at the same time. That tension will shape policy, taxes, regulation, and ultimately, long-term returns. On a lighter note, this entire channel, the research, the scripting, the visuals you're watching right now, is powered by Fludge.io. If you've ever thought, I'd love to run a YouTube channel like this, but I don't want to be on camera, I don't have time, and I don't want to drown in editing software, that's literally what Fludge is built for. It finds trending topics in your niche, builds a solid, structured script, generates an AI avatar, creates thumbnails, and uploads everything for you. Your job is to review, tweak if you want, and hit publish. And no, it's not that low-effort AI spam you scroll past in 2 seconds. If you're still here listening to me break down macro, that should tell you something about the quality. So if you're into finance, news, education, or just have a weirdly specific hobby you want to turn into a channel without showing your face, check out Fludge.io. Bringing it back to the markets, here's the bottom line. This very bullish catalyst, the idea that we're gliding into a soft landing with rate cuts ahead, could absolutely supercharge stocks. If inflation keeps trending down, if the labor market cools slowly instead of collapsing, if earnings stay resilient, and if nothing catastrophic breaks in credit, then yes, we could be in the early innings of another leg higher. Not guaranteed, not inevitable, but possible. But the same way my parents learned with that bank advisor, and the same way I learned watching headlines get twisted in the newsroom, you cannot outsource your thinking to anyone's narrative. not the doomers, not the permabulls. So let me throw it to you. Do you think this soft landing plus rate cut story holds together? Are we at the start of a new bull run? Or is this just the calm before the next surprise everyone claims they never saw coming? Drop your thoughts, your hot takes, and your worries in the comments. I read them, I learn from them, and I steal the best ones for future episodes. And if you want more data first, sarcasm-heavy breakdowns of what actually matters in markets and the economy, hit subscribe so you don't miss the next one.